Hey everyone, this is the first lesson of Ethan Trade Stocks. Today, we will learn about stocks, bonds, and mutual funds. First of all, what is the stock market? It's a place where people buy and sell a share of a company's equity. Think of it as something like eBay, a marketplace where people can buy and sell a variety of different shares. Equity is the value of a company if it was for sale. This value can be determined by subtracting all of the debt and liabilities of a company by its total assets. What is a stock? A stake in a corporation that is publicly traded through the stock market. In essence, owning the stock of a company is making you a partial owner, called a shareholder. Imagine a stock as a small slice of a company out of a huge pie. Every stock has a price. This is the amount of money you buy it for and the amount of money you can get if you sell it. Depending on your strategy, you may make or lose money when the price changes. What is a bond? A bond is a publicly traded loan from an investor to a borrower. Imagine you give your friend $5 for cookies at school. You tell him he has to give you that $5 back within a week, plus an extra $1 as interest. You both sign a written agreement to cement this exchange. The next day, you really need your money back. Since your friend who loaned you the money does not have the full $5 yet, you sell that note to one of your other friends for slightly less money than what your full profit would have been. Doing this does not allow you to realize the full potential of this investment, but allows you the ability to cash in quick. This is called liquidity. You can buy and sell bonds on the bond market, so it's not on the stock market, it's on the bond market. A company or the government usually issues bonds, and depending on their credit ratings, you get different returns. So a US Treasury bond is rated AAA, so it's very safe. You know you're going to get your money from them, but you're not going to get that much returns. The lesser rated bonds, the double B plus to the D, you may not even get your money back. They might default on their loan. You may not get it, but once you do get it, there's a lot more interest. And the ways to make money from these bonds is having the borrower pay back the principal, which is how much you gave them, plus the interest, or you sell the bond when the interest rates decline, causing the bond prices to rise. What is a mutual fund? It is a public investment fund where professionals manage a portfolio funded by everyday people. Think of it as a way to invest in many different companies without buying each individual one separately. So if you're tight on money, but you still want to have a very diverse portfolio and buy a bunch of different stocks, you could buy this one mutual fund that encompasses all of them. So having professionals do the research and decide when to buy and sell each asset to give the best return may be invaluable depending on the situation. The pros of this is that you need less money to put in multiple places, giving you a diverse portfolio that is safer than having all your eggs in one basket. You also have a pro managing it for you, so they may have better investment strategies than you. And it also needs very little attention, so you can invest and forget about it. The cons is that the fund has such a diverse portfolio with so much money in it, is that they need almost every asset to do very well in order for them to make any money, which is very hard because they have so much that even if something goes up tenfold, you're not getting any really increases on your part. Additionally, the fund charges a managing fee, which they take out of your returns, which also makes you have even less money from this investment. What is an index fund? It is a type of mutual fund that groups all the stocks that fit into a certain criteria in order to track a certain type of market at large. The S&P 500 tracks the 500 largest companies in the USA. This can give you an idea of whether this market is bear or bull. Bull as in the majority of things are going up in price, and a bear as if they're going down. This can give you an idea if it's a good time to invest or not. However, this may be deceiving because some stocks may be doing great and others may be doing bad, which is bringing it down. So even if one's doing amazing, you may not understand that from this S&P 500 or other market average. Thank you so much for watching this. I really appreciate all the support from you guys. I can't wait to see you next time. Bye.